So you want to become financially free and you got real estate on the brain, which is awesome. What strategy should you follow? Should you flip houses? Should you wholesale? Should you do the BRRRR method? What is it exactly? I want to literally shave years off your journey because I've done all those things. I don't want you to make the same mistakes I did. Some of those strategies may or may not get you to your ultimate goal of financial freedom. Let's do this. Why don't you join me on what I call my rocky road to financial freedom? I kind of call myself the crash test dummy of financial freedom because I've done almost everything under the sun, tried all kinds of strategies and things, and some worked and some didn't. So here's what we're gonna do. We're gonna kind of analyze and look at all these real estate strategies you probably heard of, and maybe some you haven't. We're gonna talk about the pros and cons of each, and we're gonna see that there's gonna be a clear winner that emerges. And that, my friends, is the winning strategy, the one that will get us to financial freedom. Are you ready? Let's do this. It was January 2015. My restaurants were losing $10,000 a month and I had nearly maxed out my $200,000 line of credit. I couldn't use the business credit card at Starbucks because it was overdrawn. I was getting nasty letters from the IRS about penalties, interest, and liens. That was no bueno. I had 3 months left before I would run out of liquidity. That's debt liquidity, by the way, not cash. And if that were to happen, I could no longer pay my employees, which meant they would quit and I'd have to shut down the store. And if that happened, the landlords would sue me for the remainder of my personally guaranteed lease. And then I would lose my house. I had bet big on a pizza franchise to achieve the passive income dream. But it turned out into a nightmare. And for what? I would have been better off just staying with my secure job that I had instead of quitting 10 years earlier to follow a dream. You know, what kind of husband was I? What kind of father? What kind of provider? Well, hey there, and welcome to the ultimate guide to financial freedom with real estate investing. The whole course is here on my channel. My name is Michael Blanc. I'm a full-time entrepreneur, investor, and coach, and I'm super passionate about helping others become financially free in the next 1 to 3 years by investing in real estate. And through my investment company, Nighthawk, we control over $300 million of real estate, and I've helped my students acquire over 13,700 units at the time of this recording. So hit that subscribe button now so you don't miss any part of this course. Yeah, it all started so innocently. My dad made a good living working for IBM his entire career. When we vacationed, man, we did it right. Every winter, we would go ski in Innsbruck, which is in Austria. I'd be in ski school all day for 2 weeks, and I got pretty good at an early age. We'd go to Hawaii, the Bahamas, Nova Scotia. Life was pretty good. But I don't remember my dad much because he was working a lot. I remember that when I was in middle school in Germany, I barely saw him. And like most people, I was taught to get good grades, and getting A's came easy to me. I started off as a biology major in college, but I switched to computer science my sophomore year because it wasn't clear to me how I was going to make any money. When I graduated in 1992, the job market was awful, so I decided to get my master's, also in computer science, at the College of William & Mary. Getting a secure job that paid well was the next logical step, of course. It was what my parents told me to do and what everybody else around me was doing as well. It would also allow me to continue seeing my girlfriend, who I had met a couple of years earlier. I didn't question it, and I continued to drift through life, doing whatever thing came my way. I became a computer programmer for a government contractor in Northern Virginia, and then took a job with the New America Online web development team. It was 1995, and the internet boom had begun. Now, while AOL was pretty cool, it wasn't nearly as exciting as what was going on at Silicon Valley, and I wanted a piece of it. So during one of our happy hours, I was chatting with our head of marketing. She told me her husband was starting a software startup not far from the office. So in January of 97, I joined as her first programmer. I was in the right place at the right time, and in 2001, the company went public and put a bunch of money in my pocket. And life was pretty good at first. But 4 years later, I was sitting in my cubicle, not getting much done, bored out of my skull, and I had been at the same company now for the past 8 years. And when I joined, it was an exciting startup, but by 5 years in, most of the fun people had left and joined other startups or started them. And I hadn't. It was just now felt like a job, and I kind of loathed the office politics. So at the time, I also had a young daughter and son and hated not being there for them during the day. I remember my daughter had a ballet recital, and she asked me if I would watch her. And I told her, well, shoot, I was sorry, honey, but I had a work function that evening. I remember the way her face dropped in disappointment, kind of like Brad's daughter probably did when in that similar situation. Now, I used to come home exhausted and with barely enough energy to help with dinner and the kids' bedtime, so I'd crash in front of the TV, decompress, and then go to bed. And weekends, I'd run errands, and I tried to recharge a battery so I could do it all over again on Monday. I don't know if that sounds familiar. I felt like the years were passing me by, and I was missing my kids growing up. I was making good money, but I wasn't able to spend time with my family. What I really wanted was to control my time, but I had to work to provide for my family. I just couldn't figure out how to do both. And then in 2004, when I was 33 years old, I had read the book Rich Dad, Poor Dad, and it hit me like a ton of bricks. I thought, I am such an idiot. It's not how much you earn or have in the bank, it's about how much passive income you were having. I didn't have very much at the time. I read that book in about a day, and it completely changed my entire financial outlook. Passive income was going to change my life. It would allow me to be financially free so I didn't have to work, and I could do whatever I wanted to do. It would allow me to provide for my family and spend time with them at the same time. I had found the solution to my problem. Now, however, lest you think I'm a genius, okay, my solution after reading Rich Dad was not real estate. It was actually a pizza franchise. Hey, if you want more content like this, go ahead and hit that subscribe button, my friends. And so my big idea wasn't real estate, it was actually restaurants. And here's why, okay? In my defense, at the time, I had invested some money in a franchise development company. It was a sales company. And during one of the company's Christmas parties, I met some of the Five Guys Burgers franchisees. You probably have one near where you are, but it came from Northern Virginia. So I knew some of those early guys, and they said, hey, this is the way you do it. You put the money in, you hire someone to run them all, and you basically sit back and count the passive income. I was like, sweet, that's exactly what Kiyosaki talks about in the book. And this is what I wanted. Now, because Five Guys was sold out in the area, right? It was super hot at the time. I went with an up-and-coming pizza franchise, and I was going to bet big. I was going to go all in and take all my chips and use it to generate passive income. So before you know it, I had 5 restaurants and an idea there that they would cover my living expenses, and then from that fund additional units. I had a world domination plan of at least 20 units in my spreadsheet, and I've set the plan in motion, my friends. So I followed the blueprint. I hired an experienced restaurant operator, signed a franchise agreement, signed my lease, and opened my first pizza restaurant in April 2006. For the next 6 months, I had bought another franchisee, turned his store around, built and opened a 3rd location. Over the next 12 months, I built 1 more restaurant and bought another 2. Okay, long story short, we had about 8 restaurants at one point. And then the recession hit and changed everything. Sales plummeted. 2 of the stores began losing money. I had no choice but to sell both locations at the worst time in history to sell anything, especially restaurants that were losing money. And I was like thinking to myself, welcome to entrepreneurship, Michael, right? So by 2009, things had somewhat stabilized. But by 2013, I realized that our profit margins that I had kind of stabilized had been slowly shrinking. And I could no longer afford this guy that was running all my restaurants. So I had to let him go. And now here I am at the time managing 6 restaurants. I'm driving to each restaurant, spending a day with the manager, and put my heart and soul into it. And certainly not something that I planned. It was supposed to have been passive income. But despite all of my energy, I failed to turn around. It was like a slow downward grind. It was like trying to catch a falling knife, and nothing I did, literally nothing, made a difference. Finally, I said, man, I gotta sell this stuff. And I didn't realize how long it would take. And I didn't realize how little value was in these restaurants that were performing so well. And, a restaurant that cost $300,000 to open, I sold for all cash for $30,000. It was gut-wrenching. It was like an complete and utter failure I've never experienced in my entire life. And what was worse is that this was a slow grind. It was an ever-increasing negative cash flow situation. I was at the point where I was losing $10,000 a month, and I was exhausting all possible lines of credit. I think I was probably 3 months away from losing everything, like all liquidity where I couldn't bill another bill at all, and I wasn't paying over half my bills. Now, fortunately, I sold that first restaurant, and in a second, and at least I cut the bleeding and put a tiny bit of money and extended the runway. This particular restaurant, as good intention as it was to get financial freedom, nearly cost me everything. During this time, I was still searching for the perfect investment because I somehow felt it was not the right thing, obviously because I'm losing money. Now, while this is all going on with the restaurants, okay, this is like a multi-year thing. But back in 2006, when I opened my first restaurant, when I quit my job in 2005 and I had read Rich Dad in 2004, I did dabble in a bunch of other things. I learned to trade some stocks and options, but I did dabble in real estate. And so I signed up with a local wholesaling mentor, and he taught me how to market for deals, postcards, bandit signs, and sure enough, off my first campaign, I acquired 2 deals. It was the same out-of-state owner, and within 6 months, I'd renovated and resold those 2 properties for $110,000. By working part-time, These 2 house flips made as much of my entire salary at the software company. That blew my mind. Still, I knew that the real money was in commercial real estate, also since it wasn't really a passive income either, but nevertheless it worked so well, I continued to flip more houses, but everything was pointing me to apartment buildings. And so in 2007, I attended a seminar, and I immediately started calling brokers in Texas and sending letters like I did on the houses, and I educated myself. I developed financial models, I analyzed deals, I called proper managers and lenders, and after 9 months of activity, I finally got a verbal agreement on an 82-unit property in College Station, Texas, where Texas A&M is. By this point, I had probably looked at like 120 deals, and I knew it was a good deal. It was a light value opportunity, needed some landscaping, some TLC, but most importantly, the rents were about $125 under market. And the property manager felt very confident making this property shine. The problem was I was building and buying restaurants. I was knee deep in restaurants. That I knew that if I did this deal, I'd have to travel to Texas, spend some time there. And I could not do both at the time. So after some thought, I decided to put the whole real estate thing on hold to focus on restaurants. Hindsight is 2020, isn't it? All right, so back to 2009. The dust had kind of settled. The recession is over. Things are starting to, quote, normalize a little bit. And I'd sold those 2 restaurants at a massive loss, but at least I stopped the bleeding. And so my life it was pretty good in 2009. So things were good. I met with my operator, and I was counting my passive income from the restaurants, did a house flip here and there, and it was pretty comfortable living. And it was like literally the second time I had become financially free. The first one was during the IPO of the software company. I was like, this is great. I was still working, but I could do whatever I wanted. This is the second time I'd become financial, because I literally was getting passive income from those restaurants. And so this allowed me to revisit my interest in real estate, and for fun and money, I started to flip houses, but more as a business. And this is a good thing, because the restaurants down in a couple of years would be a real problem. So I had another income stream through the house flipping. But at the time in 2009, there was this huge foreclosures, which means I could buy a house for $80,000, put in $35,000, and sell it for $185,000. And so my original plan was to get back in apartment building investing, but it was too good of an opportunity to pass up. Yeah, I had to do the house flip thing. My biggest problem was, though, that I had none of my own money left. I had deployed my entire net worth into the restaurants. Now, I'm not complaining, because at the time it was actually working, okay? It was actually doing what I wanted to do. The recession was a setback, a pretty major setback, and we kind of rejiggered everything, and we're making money again. That was pretty cool, but there just wasn't any cash left to invest. So I thought, well, maybe I can convince some friends to invest. So I proposed a $25,000 loan, paid them 12% interest, and so my father-in-law and brother-in-law were first to kind of the bite. And then I recruited a friend. And that's when I had a huge aha moment. My ability to scale this business is only limited by my ability to find deals and raise money, not by my lack of financial resources. Now, over the next 3 years, I raised $1 million and flipped over 30 houses. And I made good money too. But there was another problem. Flipping houses was a ton of work, it turns out. I realized that if I wasn't buying, fixing, or selling a house, I wasn't going to make money. There was never any residual income after selling a house. It kind of felt like a full-time job, and I was burning out. I then thought about building up a portfolio of single-family houses instead of flipping them, but then I discovered a second problem. I wasn't going to be able to replace my income with single-family house rentals. One day I sat down at my kitchen counter and put pen to paper to try to figure out how many houses I would need to own to replace my income. My goal was $10,000 per month. I felt that if I bought right, I could get each rental to cash flow $200 per month. At that rate, I would need at least 50 houses in my portfolio. Are you kidding me right now? 50 rentals? How long would that take? Okay, a long time. And how much work would it be? A lot of work. And that's when I remembered my apartment building training back in 2007, and I realized that investing in apartment buildings had several major advantages over single family houses. So I discovered 6 reasons that made apartment buildings better than single family house investing. But before I cover those, hit that subscribe button and notification bell now so you don't miss any part of this course. Number 1, apartment building investing is more passive. Unless an investor has a large portfolio of houses, it's not common to have a property manager to manage the houses. I found that most of the time investors were self-managing their single-family houses. On the other hand, with apartment buildings, professional property management is built into the business model. Once I found a good property manager, he or she would find and pre-screen the tenants, answer phone calls, in the middle of the night, and handle repairs, collect the rent, and then track all of this with reports that I could review. The passive nature of apartment building investing really appealed to me over the more active work of single-family house investing. Number 2, you can control the value of an apartment building. I knew that the value of single-family houses was determined by what other houses in the same area sold for in the last 6 to 12 months. These are called sales comps. Now, even with a rental property, if one got a little bit more rent than the other, it would still be valued about the same, all things being equal. Now, with apartment buildings on the hand, and commercial real estate in general, it's different. It's much less about sales comps and much more about how much net income the property produces. So the more income it produces, the higher the value. I could have two identical buildings next to each other and one could be worth more because it produces a higher net income than the other. Now, the implications of this are enormous if you think about it. I could buy an underperforming building, perhaps one whose rents are low, expenses are high, and I could increase the income, decrease the expenses, maybe by using a professional manager, and as a result of those efforts, the property could be worth substantially more than before. And it didn't depend on how much the building down the road sold for either. Sales comps were not as relevant. It was solely dependent on how much net income it was producing. So with apartments, I wasn't dependent as much on the market because I can't control that. But I could control the value by influencing net income it could produce. That's very powerful. Number 3, apartments are less risky than houses. According to the Housing Finance Policy Center 2015 chart book, the Freddie Mac delinquencies peaked at 4% for single-family houses. So 4% were in delinquencies. These are government-backed, right? And FHA delinquency was even higher at 9%. At the same time, these FHA government-backed delinquencies for multifamily products peaked at 0.4. And that included California, Arizona, Florida, the hardest hit parts of the country. In other words, multifamily delinquency rates were 90% lower than the residential rate during the worst economic downturn since the Great Depression. This might explain the next point. Number 4, you can get cheap and unlimited financing. Because of the recession, there were now limits to how many houses someone could finance with bank loans. So through long-term banking relationships, some investors were getting around that through commercial loans, but they were almost always personally guaranteed, and not everybody got them. So personally guaranteed means that, hey, if you lose the house, the bank's gonna go after your personal assets. The banks were lining up to fund apartment buildings. The interest rates were incredibly low. You can get as many loans as you wanted. And in most cases, you can get not what's called non-recourse loans, which means that don't have to be personally guaranteed, right? And there's no limit. Now, why is that? And the reason is because banks associated apartment buildings as a much, much lower risk than single-family house. Therefore, again, indicating what they perceive to be the risk level of apartments versus single-family houses. The number 5 reason I like apartment buildings, you can get paid for what's called syndicating apartment building deals. Syndication is the process of finding deals, raising the down payment from private investors, putting the deal together, getting the financing, putting the proper management against. All that is called syndication. And what I discovered is that syndicators get paid for doing this, putting the whole thing together, and they get paid in 3 ways, which is really cool. So upfront, okay, you get paid upfront, something called an acquisition fee, which can range typically around 3% of the purchase price. And you get paid that at closing when you buy it. And so for a small $1 million deal, that's $30,000 you get paid at closing. That is very, very, very powerful. You also get paid while you own the asset, typically with asset management fees that are 1 to 2% of the income you get in. You also get what's called sweat equity in a deal. For putting the deal together, not only do you get an acquisition fee, but you also get 10, 20, 30, 40% of the deal just for putting the deal together. Now, you also can get paid when you sell or refinance the asset. So one way to do that is a capital transaction or disposition fee. Again, another 1 to 3% of the sales price. When you return the principal back to the investors, you get paid for that. And of course, you get paid your share of the equity as well, the profit. So I discovered through that I can massively scale my income, both through the acquisition fees and the passive income, but also the equity and the wealth that I'm building with apartments. Number 6, apartments are much more scalable than single family houses. When I revisited my goal of achieving $10,000 of passive income per month, I determined that I might need to syndicate and control about 100 units, let's say. Okay, so rather than buying 50 single-family houses, which would take a lot of work and time, I could probably control 100 units in just maybe 3 deals in the next 1 to 3 years. And at that point, I could quit and sit on the beach, or could just keep doing and build a legacy that I could pass on to my children. So, 50 houses or, 2 or 3 deals over the next 1 to 3 years. Now, of all the business I had done, all the shenanigans I'd done, software flipping, rental, short sale negotiation, options trading, restaurants, only apartment buildings have a unique combination of passive income, control, favorable risk profile, availability for financing, and scalability. From that point forward, when I realized all that stuff, my plan was to focus only on apartment buildings. So I dusted off the old apartment building stuff, the books and the analyzers, and I started looking for deals in the DC area where I had flipped, 3 dozen houses in that area. And this new plan had to work because at this point, the restaurants were losing money and I was a bit in dire straits, and I had no other source of income except for the house flips I was doing at the time. And to me, going back to a regular job was unacceptable. And so to me, in my mind, there was no plan B, and I knew I had to make this work. But I had 2 problems. I didn't have any money to invest, and I didn't have the experience with apartments. What was odd is that despite my house flipping resume, brokers and sellers weren't taking me seriously. They would ask, okay, that's great, Mr. House Flipper, how many apartment buildings have you done? I said, well, none, but look at all the houses I flipped. And it was like, come back to me when you've done an apartment building deal. And I was frustrated. I felt like I was stuck and I couldn't get into this world. I thought I needed a ton of money to get started, which I didn't have. And then I thought, well, shoot, my single family house investors surely would want to invest in apartment buildings, but they didn't, because the money was more, and the hold time was 5 years instead of 6 months. So my regular house investors were not interested in going with me to apartments. I was frustrated by all of these stuff. And so I then discovered some tricks, some tricks I learned over the months and years of doing that, where I got brokers to take me seriously. And so they wouldn't ask me about my track record, which I didn't have. And I'm going to share those tricks with you as well. And I'm also going to share with you ways that we can raise capital from people without feeling like you beg people for begging or manipulating them. So we're going to talk all about raising capital in a little bit as well. So in 2011, one of my wholesalers, these are the guys who bring me the house flip deals, they contacted me about a 12-unit apartment building in DC that he had under contract. It was listed by one of his realtors, and he thought I should take a look at it. And I ended up closing on that deal with none of my money. So in the next video, I'm going to share with you how that first deal, that first small 12-unit deal, literally made me $40,000 per year over the 5 years I had that thing, so that you can understand the true power of apartment buildings. So hit that subscribe button right now so you don't miss the step-by-step process of how I achieve financial freedom, so that you can do the same. So let me know your thoughts or questions in the comments, and I'm going to see you in the next video.